Disclaimer.
By the time the opening bell rings on Monday morning, the silver market you knew on Friday will be gone. While the mainstream media focuses on the $100 price tag, the real story is the ghost inventory. Major North American dealers are showing availability, but behind the scenes, delivery times have quietly slipped to 6 weeks. Why? Because the Shanghai Premium has just hit a record 450, and China has officially turned off the export tap to feed its own industrial machine. If you're holding paper silver, you're holding a promise that can't be kept. If you're holding physical, you're about to witness a decoupling that hasn't happened in our lifetime. Let's look at the data the banks hope you don't see before tomorrow's open. So what exactly is this ghost inventory? And why should it concern every American with silver exposure right now? Here's the reality that most investors won't discover until it's too late. When you visit your favorite online bullion dealer this weekend and see hundreds of silver products marked in stock, you're looking at listings for metal that doesn't actually exist in a vault anywhere in the United States. You're looking at what insiders are calling ghost inventory, and it is about to rewrite everything we thought we knew about precious metals markets when Monday's opening bell rings. Here's what should grab your attention this weekend while you're scrolling through dealer websites, seeing green available, buttons next to silver eagles and bars. Something unprecedented is happening behind the curtain. The United States Mint has quietly entered what industry veterans call a silent allocation phase. That's not a term you'll find in any press release or official statement, but if you call the right refiners and ask the right questions, you'll hear the same story whispered across our domestic supply chain. The bars you see listed online have already been pre-sold, sometimes 3 or 4 times over, to buyers who placed orders weeks ago and are still waiting for delivery. Think about that scenario for a moment. You could theoretically click Buy Now on a silver product tonight, receive an order confirmation, and have your money withdrawn from your account, while the actual metal backing that transaction sits in a warehouse in Singapore, hasn't even been refined yet. According to data from the Silver Institute's latest quarterly report, our domestic refining capacity is running at 104% utilization, meaning every ounce that comes out of the system already has a buyer's name on it before it cools down from the casting process. But here's where it gets genuinely concerning for anyone holding paper positions or planning to convert their positions to physical metal next week. The lease rates for physical silver just hit a 15-year high of 4.2%, and most investors have no idea what that number actually means for their portfolios. When you hear lease rate, you might think that sounds technical or irrelevant to your situation, but let me put this in perspective. Banks and major institutions borrow physical metal from each other constantly to satisfy immediate delivery demands from industrial customers who need silver for solar panels, electronics, and medical devices. These aren't optional purchases that companies can delay. These are manufacturing lines that shut down without the raw materials. Have you noticed what happens when banks get desperate? The cost of borrowing anything skyrockets, and according to London Bullion Market Association data, we're watching something that hasn't occurred since the 2011 silver peak. Major financial institutions are paying 4.2% annually just to borrow metal for short-term delivery obligations, which tells us they can't source it through normal channels anymore. Think about your own financial life for comparison. If you suddenly had to pay 4.2% interest just to borrow something for a few weeks instead of buying it outright, that would signal you're in a serious supply crisis, not a normal market condition. What makes Monday's opening particularly critical is the growing separation between two completely different silver markets that are supposed to represent the same asset. While the paper price on the Comex Futures Exchange continues trading in a familiar range that looks calm and controlled on your screen, something radical is happening in the physical market where real metal changes hands. The Shanghai Premium, which measures how much more buyers in Asia are paying compared to New York prices, has widened to a record $450 per ounce this week. According to customs data released by the Shanghai Gold Exchange, Chinese buyers are now paying $4.50 more than the official Comex price to get their hands on actual silver bars, and that gap keeps expanding every single trading session. Let me walk you through what this means for our investment positions. When the Eastern markets are willing to pay significantly more for the same ounce of silver that's supposedly trading for less in New York, we're watching price discovery shift from west to east in real time. For the past century, our markets in London and New York set the global price for precious metals. If you wanted to know what silver was worth, you looked at the Comex closing price, and that number determined what everyone else paid around the world. That system is breaking down right in front of us, and it is happening so quietly that most American investors won't realize what occurred until they try to convert their paper positions to physical metal and discover the price they're seeing on their screen no longer matches what they have to pay for delivery. The mechanics of this decoupling are actually quite simple once you understand the players involved. The Comex operates primarily as a paper market where massive contracts representing millions of ounces trade hands electronically throughout the day. According to the Commodity Futures Trading Commission's latest commitment of traders report, for every ounce of physical silver registered in Comex vaults, there are approximately 450 ounces worth of paper contracts claiming ownership of that same metal. This works fine as long as everyone agrees to settle their contracts in cash rather than demanding delivery of actual bars. But what happens when industrial users in Asia stop accepting cash settlements because they need the physical metal to keep their factories running? You're watching a game of musical chairs where the music is about to stop, and the Eastern markets just claim the last available seats, while our paper market continues operating under the assumption that silver is abundant and readily available. The physical market has moved into a scarcity phase that the pricing mechanism hasn't caught up with yet. We've seen this movie before in other commodities, but never quite like this with precious metals, and never with this much industrial demand stacked on top of the traditional investment demand. Here's the part that should make every silver holder pay attention this weekend. The separation between paper and physical isn't just some abstract concept that affects big institutions or foreign buyers. When you hold a silver ETF or a futures contract or even a pooled storage account, you're participating in the paper side of this market. You own a promise that you can convert your position to physical metal at the current quoted price whenever you choose. But that promise depends entirely on there being enough metal in the system to honor everyone's conversions. And the data suggests we're approaching a point where the math simply doesn't work anymore. According to the World Silver Survey published last quarter, global industrial demand for silver has increased by 17% year over year, driven primarily by solar panel production and the electric vehicle supply chain. At the same time, mine production increased by less than 2%, creating a fundamental supply deficit that's being filled by drawing down existing stockpiles. You can run that math for a few months, or maybe even a year or two. But eventually, you hit a wall where the stockpiles run empty and the paper claims exceed the physical reality by such a wide margin that confidence in the whole system evaporates. What should concern you most as we head into Monday's session is the speed at which this situation has deteriorated. 3 months ago, the Shanghai Premium averaged around 75 cents per ounce, a spread that's actually quite normal for shipping costs and local market conditions. We've gone from 75 cents to 4.50 in less than 90 days, which represents a complete breakdown in the arbitrage mechanism that's supposed to keep global prices aligned. Sophisticated traders should be buying silver in New York where it is cheaper and selling it in Shanghai where it is more expensive, pocketing the difference until the prices converge. But that arbitrage isn't happening anymore, which tells you that the metal available in New York can't physically be moved to Shanghai fast enough to meet demand, or it doesn't actually exist in the quantities the paper market claims. The silent allocation phase I mentioned earlier is not just affecting retail buyers trying to purchase a few rolls of silver eagles for their personal collection. According to conversations with industry sources who spoke on condition of anonymity, even major institutional buyers placing 7-figure orders are being told to expect delivery windows stretching into April and May, and those dates keep sliding further out every week. This is our domestic refining system, the backbone of American precious metals infrastructure, essentially admitting it can't keep up with current demand even while running above theoretical capacity. You have to ask yourself a fundamental question as we approach Monday's opening. If the metal exists in the quantities that the paper market suggests, why would lease rates be at 15-year highs? Why would major banks be paying significant interest to borrow metal for short-term delivery when they should be able to simply purchase it outright at the current quoted price? Why would Eastern buyers pay a 4.50 premium when they could theoretically buy from New York at a discount and ship it across the Pacific? The answers to these questions all point in the same direction, and it's not a direction that's friendly to paper positions, held over a weekend when Asian markets have 6 hours to react to any developments before our markets even open. What we're witnessing is the early stage of a supply shock that most investors won't recognize until it's already impacted their positions. The ghost inventory sitting on dealer websites creates an illusion of abundance that masks the reality of a market that has already allocated every ounce several times over. When Monday's bell rings and the decoupling between paper and physical becomes impossible to ignore anymore, the investors who understood this dynamic will be positioned in actual metal while everyone else scrambles to convert paper promises into physical reality at whatever price the market demands. That gap between where we are now and where we'll be by Monday afternoon is the opportunity and the warning that this weekend presents. Now let me show you the data that proves this isn't speculation, but a mathematical certainty already reshaping global metal flows while most American investors sleep through the weekend. The Eastern Siphon, as commodity traders are calling it, represents the largest peaceful transfer of physical wealth from west to east since the gold window closed in 1971, and it's happening at a pace that should concern anyone holding paper silver positions. Start with India, because what's happening there right now is rewriting the entire precious metals playbook. According to customs data released by India's Ministry of Commerce and Industry, the country imported more silver in the first 20 days of January 2026 than it did during the entire first quarter of 2025. Think about that timeline for a moment. We're talking about a nation of 1.4 billion people that traditionally bought gold for weddings, festivals, and wealth preservation, suddenly pivoting to silver with an intensity that's caught every major bank off guard. The numbers are staggering when you break them down. India pulled in approximately to the 100 metric tons of silver between January 1st and January 20th, which represents roughly 67.5 million ounces flooding into a country that's now competing directly with our industrial buyers for the same limited global supply. But here's where it gets interesting, and this is the part that connects directly to your portfolio regardless of whether you own silver or not. Why would millions of Indian middle-class families suddenly shift their centuries-old preference away from gold? The answer is simple mathematics that applies to American savers just as much as it applies to buyers in Mumbai or Delhi. With gold crossing $5,000 per ounce and sitting near all-time highs, the affordability factor has completely changed for average families trying to preserve their purchasing power. According to a survey conducted by the All India Gems and Jewelry Domestic Council, a typical middle-class Indian family that used to purchase 10 grams of gold for a wedding or festival now finds that same amount costing nearly twice what it did just 3 years ago. Silver, trading at a fraction of gold's price but offering similar inflation protection benefits, has become the accessible alternative for millions of households that still want to own physical precious metals. You might be wondering what Indian wedding purchases have to do with your silver position here in the United States. The connection is direct and immediate because those 67.5 million ounces that flowed into India in 20 days had to come from somewhere. And that somewhere is the same global supply chain that feeds our domestic refiners, our industrial manufacturers, and our investment demand. When a new buyer, the size of India's middle class, enters the market with that kind of purchasing power, it doesn't expand the pie. It just means everyone else gets a smaller slice, and our slice is shrinking faster than most investors realize. Now layer China's move on top of India's surge, and you'll understand why Monday's opening could feature price action that looks nothing like normal market behavior. Last week, the Chinese Ministry of Commerce announced new restrictions on silver nitrate and high-purity bullion exports under what they are calling the Green Energy Resource Act. And the implications of this policy shift extend far beyond what the limited mainstream coverage suggested. According to data from China Customs, the country has been exporting approximately 120 million ounces of refined silver annually to Western markets, with a significant portion of that being solar-grade purity metal that our domestic solar panel manufacturers depend on for production. Let me put this in perspective using a scenario you can relate to. Imagine you run a solar installation company here in the United States, and you've been relying on Chinese refined silver to meet your manufacturing contracts for the past 5 years. Your supply chain works smoothly, your costs are predictable, and you've built your entire business model around the assumption that you can source high-purity silver at current market rates, plus a reasonable premium. Then, on a Friday afternoon, you get an email from your supplier explaining that starting Monday, they can no longer fulfill your standing orders because Chinese export licenses have been suspended indefinitely. What do? You immediately start calling every other supplier you can find, offering to pay whatever premium is necessary to keep your production lines running. And you discover that every other solar manufacturer in the Western world is making the exact same phone calls at the exact same time. That's the short squeeze unfolding right now in the industrial silver market. And it's a squeeze that cannot be settled in cash because these companies need physical metal to manufacture actual products. According to the Solar Energy Industries Association, our domestic solar installation capacity has grown by 22% annually for the past 3 years, translating to silver demand that increases by roughly 15 million ounces per year, just from that one industry sector. When you cut off 20% of the West's solar-grade supply through Chinese export restrictions, while demand continues accelerating, you create a bidding war for the remaining available metal that pushes prices far above where paper contracts are currently settling. Have you checked what's happening in the Comex vaults lately? This is where the math becomes truly concerning for anyone who believes their paper position represents actual metal they can claim when needed. JP Morgan's registered vault category, which represents metal that's available for immediate delivery against futures contracts, has dropped below 30 million ounces for the first time in the modern era of precious metals trading. According to the CME Group's daily vault reports, the total registered silver across all Comex vaults currently sits at approximately 68 million ounces as of the most recent reporting date. Now here's the calculation that should keep paper silver holders awake this weekend. The Commodity Futures Trading Commission, its commitment of traders report, shows open interest on Comex silver futures, representing roughly 900 million ounces of paper claims. You've got 68 million ounces of registered metal available for delivery, and 900 million ounces worth of contracts that could theoretically demand that metal. The ratio works out to less than 1 physical ounce for every 13 ounces of paper claims, and that's using the total registered category. If we focus specifically on JP Morgan's vaults, which have historically served as the backstop for the entire system, we're looking at 30 million ounces, covering a proportional share of those paper claims, which pushes the ratio closer to 1 ounce of physical for every 450 ounces of paper. Think about your own financial life for a moment and apply this same math to something familiar like your bank account. What if you discovered that your bank only kept one actual dollar in the vault for every $450 in account balances across all customers? The system works fine as long as everyone doesn't show up demanding their cash at the same time. But the moment confidence cracks and people start lining up for withdrawals, the mathematical reality becomes impossible to ignore. That's precisely where we are with the silver market right now, except instead of depositors lining up outside a bank branch, we have industrial users in Asia willing to pay substantial premiums for physical delivery, while Western investors continue trading paper contracts as if nothing has changed. The timing of the Eastern siphon couldn't be more critical for our markets and our domestic supply security. According to the World Bureau of Metal Statistics, global silver mine production has remained essentially flat over the past decade, increasing by less than 1% annually despite silver prices more than doubling during that same period. This is not like oil or copper, where higher prices incentivized new production that eventually brings supply back into balance with demand. Silver is primarily a byproduct metal, with approximately 70% of new silver coming from mines that are actually digging for copper, gold, zinc, or lead. That means you can't simply ramp up silver production by opening new silver mines, because most miners are not looking for silver in the first place. They're recovering it as a secondary output from operations focused on other metals. What happens when industrial demand from solar panels, electronics, and electric vehicles grows by 17% annually, while mine production grows by less than 1%? You get exactly what we're seeing now. A structural deficit that's being filled by drawing down existing stockpiles, leasing metal from financial institutions at escalating rates, and watching the Eastern markets bid up prices to ensure they capture the available supply before Western buyers even realize what's happening. According to the Silver Institute's most recent World Silver Survey, the global market ran a deficit of 215 million ounces last year, meaning demand exceeded newly mined supply by that substantial margin. That deficit was covered by recycling old electronics, melting down jewelry and silverware, and most importantly, by liquidating stockpiles that have been built up over decades, but are now being depleted at an accelerating rate. China's export restriction specifically targets the highest value segment of the silver market, because this is not just about total ounces. It's about purity grades that are essential for specific industrial applications. Solar-grade silver requires 99.99% purity or higher. And according to industry sources familiar with the refining process, China has invested heavily in high-purity silver refining capacity over the past decade, and they now control approximately 30% of global solar-grade production capacity. When they restrict exports of silver nitrate, which is the precursor chemical for producing the silver paste used in solar cells, and high-purity bullion, they're essentially cutting off the most critical segment of supply right at the moment when our domestic solar industry needs it most. The India situation compounds the China problem because you're not dealing with one country changing its policies. You're watching two massive markets with completely different motivations simultaneously absorbing physical silver at a pace that the global supply chain simply cannot sustain. India wants silver for cultural and investment purposes, driven by millions of middle-class families making individual purchasing decisions that collectively represent enormous demand. China wants to control silver for strategic industrial purposes, ensuring their domestic manufacturing sector has priority access to critical materials while Western competitors scramble for scraps. These two demand drivers aren't competing with each other. They're both pulling from the same limited Western supply, creating a pincer movement that's squeezing our domestic availability from multiple directions at once. According to conversations with refiners who operate in both hemispheres, the physical metal flows have completely reversed over the past 90 days. Traditionally, Western refiners would process ore, create bars and rounds, and ship a portion to Eastern markets while retaining the majority for domestic industrial and investment demand. That flow has now inverted, with Eastern buyers prepaying for production months in advance and offering premiums substantial enough that refiners have economic incentive to prioritize Asian orders over domestic fulfillment. You're seeing the free market work exactly as designed, with supply flowing to the highest bidder. Except the highest bidder isn't in New York or Chicago anymore. It's in Shanghai and Mumbai, and they're willing to pay prices that make the current Comex quotes look like outdated relics from a market structure that no longer exists. What should genuinely concern you as an American investor or anyone with retirement savings exposed to precious metals is how quickly this transition occurred and how little mainstream awareness exists about what's really happening. 3 months ago, silver was considered a boring industrial metal with modest investment demand and ample supply. The narrative was consistent. Plenty of metal available, mining production adequate to meet demand, no supply concerns on the horizon. Fast forward to today, and we're looking at record premiums in Asia, historic lows in Comex registered inventories, 15-year highs in lease rates, and major exporting nations restricting shipments. That's not a gradual shift that gives markets time to adjust. That is a supply shock that's already in motion, and Monday's opening bell will simply reveal to Western investors what Eastern buyers have known for weeks. The final piece of evidence that validates everything I've been laying out comes from the forward curve in the silver market, which tells you what professional traders think metal will cost for delivery at future dates. According to the CME Group data, the forward curve has shifted into what traders call backwardation, meaning near-term delivery commands a premium over contracts that settle months from now. In normal commodity markets, the curve slopes upward because storing metal costs money, so future delivery should cost more than immediate delivery to compensate for storage, insurance, and financing costs. When the curve inverts and near-term metal costs more than future metal, it signals that buyers are desperate for immediate physical delivery and are willing to pay a premium to get it now rather than wait. That backwardation has deepened over the past 2 weeks, with March contracts trading at a significant premium over contracts that settle in June or September, telling you that the market is pricing in a supply squeeze that's happening right now, not some theoretical future scenario that might develop over time. Now let's talk about the mathematical reality that makes everything we've discussed inevitable rather than speculative, and why the 100-hour collared silver price that mainstream analysts are finally starting to whisper about represents the floor, not the ceiling, of where this market is heading. What I'm about to show you is what insiders are calling the industrial inflection point, and it's the calculation that explains why no amount of wishful thinking or paper manipulation can prevent what's coming when Asian markets open in a few hours. Here's the simple math that should concern every American with exposure to silver markets. According to the International Energy Agency's latest renewable energy forecast, global solar panel installations are projected to reach 450 gigawatts of new capacity in 2026, continuing the exponential growth trend we've seen over the past 5 years. Each gigawatt of solar capacity requires approximately 220,000 ounces of silver for the photovoltaic cells that actually convert sunlight into electricity, which means we're looking at roughly 99 million ounces of silver demand just from new solar installations this year. Now add in the electric vehicle sector, where according to the International Council on Clean Transportation, global EV sales are expected to hit 25 million units in 2026, with each vehicle containing between 25 and 50 grams of silver in various electrical components. That's another 20 to 40 million ounces, depending on vehicle mix and technology standards. But here's where it gets interesting, and this is the part that most analysts who focus on annual supply and demand miss completely. We're not just talking about this year's demand, we're talking about cumulative deficit that compounds year after year because the structural imbalance aren't getting better, it's accelerating. The Silver Institute's data shows we ran a 215 million ounce deficit last year. And with solar installations growing 22% annually and EV production scaling even faster, we're looking at a deficit that could easily hit 300 million ounces by year-end 2026. Think about what that number represents in practical terms. Global silver mining production totals approximately 830 million ounces annually, according to the World Silver Survey, which means we're running a deficit equal to more than 1/3 of total annual mine output. You can't sustain that trajectory for long before the mathematics overwhelm the system. Let me put this in perspective using a scenario that connects to your daily financial reality. Imagine you earn $100,000 per year, but your essential expenses, the bills you cannot avoid paying, total $136,000 annually. For a while, you can cover the gap by drawing down savings, selling assets, or borrowing from family and friends. But eventually you hit a point where the savings are exhausted, the assets are liquidated, and the people you've been borrowing from realize you have no path back to solvency. That's where we are with the global silver market right now, except instead of personal finances, we're talking about industrial supply chains that power everything from your smartphone to the solar panels your neighbor just installed on their roof to the electric vehicle you might be considering for your next car purchase. What makes Monday's opening particularly critical is something traders call gapping, and if you've never experienced it in a commodity market, you're about to get an education that could impact your portfolio in ways you didn't anticipate. Gapping occurs when buying pressure becomes so intense overnight that when markets reopen, there are no sellers willing to offer metal at the previous closing price. The bid-ask spread, which normally might be a few cents per ounce for liquid markets, simply disappears because everyone with physical metal realizes simultaneously that the old pricing structure no longer reflects reality. According to conversations with retail dealers who operate in both the paper and physical markets, several major firms are already preparing internal memos explaining to customers that Monday morning orders may not be honored at quoted prices, and that premiums could spike to 50% over spot virtually overnight. Think about what that means if you're holding a paper position right now and planning to convert to physical metal on Monday. You might be looking at a spot price of $35 per ounce on your screen, feeling comfortable that you can convert whenever you choose, only to discover Monday morning that dealers are either canceling orders or demanding $52.50 per ounce to deliver actual metal. That's not a hypothetical scenario. That's the reality that played out in palladium markets back in 2021 when Russian supply disruptions created a similar physical shortage, and premiums spiked from the normal 2 to 3% over spot to more than 40% in a matter of days. According to the London platinum and palladium market, some buyers waited months for delivery even after paying those elevated premiums, which tells you that once confidence in the paper-to-physical conversion mechanism breaks down, it doesn't repair itself quickly or easily. Now, here's the calculation that explains why $100 silver isn't just possible but probable once this supply squeeze fully manifests in our markets. At current prices around $35 per ounce, silver is trading near its production cost according to data from primary silver miners like Pan American Silver and Hecla Mining. These companies report all-in sustaining costs between $28 and $32 per ounce, which means there's minimal profit margin at current prices to incentivize expansion of production capacity. But here's the critical point. Even if prices doubled to $70 per ounce tomorrow, it wouldn't solve the supply deficit because, as we discussed earlier, 70% of silver comes as a byproduct from mines that are digging for other metals. Those operations aren't going to accelerate copper or zinc production just because silver prices increased, which means the supply response that normally balances commodity markets simply does not function the same way with silver. What happens when you have structural demand growing at 15-20% annually, supply growing at less than 1% annually, and no price-sensitive supply response to bring things back into equilibrium? According to commodity analysts who've studied similar situations in rhodium, lithium, and rare earth elements, you get price spikes that look completely irrational to outside observers, but are actually just mathematics asserting itself after years of market distortions. The Bank for International Settlements released a working paper last year examining commodity supercycles, and their research showed that once a structural deficit reaches approximately 30% of annual production, which is right where silver sits today, prices typically need to increase by 200% to 300% to destroy enough demand and incentivize enough recycling to restore balance. Let me walk you through what demand destruction actually means in practical terms, because this is where the rubber meets the road for industrial silver users and investment holders alike. At $35 per ounce, silver represents a manageable input cost for solar manufacturers, electronics companies, and EV producers. The silver content in a typical solar panel might add $15 to the final retail price, which is negligible when you're selling panels for $300 each. But at $100 per ounce, that same silver content adds $43 to the panel price, and suddenly manufacturers start investigating alternative technologies, thinner silver layers, or completely different photovoltaic designs that use less precious metal. According to the International Energy Agency's technology roadmap, every major solar manufacturer has research programs exploring silver reduction, but implementing those alternatives takes years of testing, regulatory approval, and retooling production lines. You can't just flip a switch and eliminate 50% of your silver consumption overnight, which means demand remains relatively inelastic even as prices spike. Here's what should grab your attention this weekend, and this is the warning that connects everything we've discussed back to your personal financial situation. If you're holding silver through an ETF like SLV or a pooled storage account where you don't have allocated bars with your name on them, you're effectively gambling on a paper system that is currently insolvent by any reasonable measure. The math is straightforward. The Comex has 68 million ounces of registered silver available for delivery against 900 million ounces worth of outstanding contracts. That's a 13-to-1 leverage ratio that works fine in normal markets where only a small percentage of contract holders demand physical delivery, but it completely breaks down in a supply squeeze, where industrial users and Eastern buyers are no longer willing to accept cash settlement. According to legal experts who specialize in commodity law, the force majeure clauses buried in the fine print of most paper silver contracts give counterparties wide latitude to settle in cash at prevailing market prices, rather than delivering actual metal during periods of extreme dislocation. That means your contract might say you own 1,000 ounces of silver, but when you try to claim delivery, you could receive a cash payment based on the Comex closing price rather than physical bars, even if the actual physical metal is trading at a substantial premium in the real world. You've essentially converted your inflation hedge into a cash position at precisely the moment when holding cash is the last thing you want to do. What makes Monday particularly critical is the timing of when different global markets open and how information flows across time zones. Asian markets will have been trading for 6 hours before New York opens, which means any overnight developments, a default on physical delivery. A major industrial buyer announcing supply shortages, or simply the continued widening of the Shanghai Premium, will have already impacted prices and positioning in Eastern markets. According to data from previous commodity dislocations, the gaps between regional markets can persist for weeks or even months when physical supply chains break down, meaning the price you see on your screen Monday morning might not represent what you'd actually pay to get metal delivered to a vault in the United States. The Amish hedge, as some contrarian investors are calling it, refers to the simple reality that in a world of digital promises and paper claims, the only thing that matters when supply chains break is actual physical possession. It's not sophisticated, it's not high-tech, and it certainly doesn't sound like modern finance, but it's the lesson that emerges every single time a commodity market experiences this kind of structural dislocation. The investors who hold allocated bars in their own names or in segregated vault accounts sleep soundly, regardless of what paper markets are doing, while the investors who thought they could convert paper to physical whenever they chose discover that the exit door narrows dramatically when everyone tries to leave simultaneously. Here's the final warning, and I want you to really think about this before Asian markets open in just a few hours. If you're not holding at least 80% of your silver position in physical metal or in allocated vault accounts where specific bars are registered to your name, you are effectively taking a bet that the paper to physical conversion mechanism will continue functioning normally through Monday's opening and beyond. Based on everything we've discussed, the 67.5 million ounce Indian surge, the Chinese export restrictions, the 30 million ounce Comex Vault collapse, the 450, Shanghai Premium, the 4.2% lease rates, and the structural 300 million ounce deficit, that's a bet with deeply unfavorable odds. The smart money isn't waiting to see what Monday brings. The smart money recognized this setup weeks ago and has already positioned accordingly, which is why we're seeing the vault drawdowns, the lease rate spikes, and the premium widening that signal the endgame is already in motion. Monday morning will reveal whether the silver market you knew on Friday still exists, or whether we've crossed into a new paradigm where paper and physical have permanently decoupled and Eastern price discovery has replaced Western price setting as the dominant force in global metals. By the time the opening bell rings and you see the first trades cross the screen, the opportunity to position yourself for what's coming will have largely passed. The ghost inventory that fills dealer websites this weekend represents the final illusion before reality asserts itself, and the investors who understood this dynamic before everyone else will be the ones positioned to benefit, while others scramble to understand what just happened to their paper positions.